Amigos, buenos noches. How's everyone tonight? Super happy to be back with you guys for another Dividend Happy Hour. Happy Friday. I hope you all had a fantastic week. And it's my favorite time of the week. Not only do we get to do this live stream and hang out with you guys, but it is also fresca clock here. I'm so stoked to break this bad boy open. And while we're on the subject, guys, why don't we just kick this thing off the best way we know how? Grab whatever it is you're sipping on, and let's do a quick toast here. So let me crack this bad boy open. Oh yeah, that thing is talking to me tonight. Sorry guys, I couldn't resist. So grab whatever it is you're sipping on, guys. Here's to you guys. Thanks for tuning in with me tonight. Episode 127 of the Dividend Happy Hour. Got a feeling this is going to be a good one. It might. Hold on. Yeah, it might. Guys, it's kind of feeling like this is going to be the best one yet. Let's see what happens. But here's to you guys. Thanks for tuning in with me tonight. And also here's to the dividends. Here's to the pursuit of that sweet, sweet cash flow. Our real, true loves here on Valentine's Day. But here's to you guys, and cheers. Stoked to be here with you tonight. Michael says, it's Valentine's Day. Get off the live. The wife will kill you. My wife, unfortunately, is working. So if my wife's working tonight, I'm working tonight too. But don't worry, Michael. I'm going to I actually have a trip planned for me and her next week. We're going to be gone Sunday through Thursday. We're going to go spend a few days at the beach. So yeah, we're working hard going into it though, but we'll have a nice few days off and a nice few days to celebrate. So coming up quick, couple more days, but I don't know, guys, I totally forgot. Let me know a few things here in the chat. Number one, what did you guys buy this week? Which stocks did you add to your portfolio? Personally speaking, I picked up a little Vici Properties. I picked up 4 shares this week. Really happy to continue buying that bad boy. I think I'm up to about 130 shares now at this point. But anyway, I picked up some Vici Properties. Let me know what you guys bought. Number 2, I want to know, what are you sipping on tonight? As you guys saw, it's Fresca Clock. Ooh, that is good. Oh, nice. A little something to take the edge off. Let me know what you're sipping on tonight. Number 3, I want to know, did anything cool happen to you guys this week, whether in your portfolio or outside of the portfolio? You know, maybe life stuff. Anything cool happened to you guys this week? I'm sure some of us are sitting on all-time highs in the portfolio. I know I am right now, guys. I'm sitting at $93.1 thousand. This is a new all-time high. It was a bit higher yesterday, actually. I think looks like I'm down about $250 today. So yesterday we were up a bit more, but man, still 93K. We are getting there, guys. We are getting there. I wonder, let's see, it's February 14th. Man, we're hitting 100K this year. That's no doubt about that. It's just a matter of when. So it'll be interesting to see how quickly that comes. If we have another month like this last one, then like we'll be there. We'll be there next month. Knock on wood. So anyway, let me know that as well. Number 4, I want to know too, do we have any first timers in the live stream tonight? If this is your first time tuning into the Dividend Happy Hour, first of all, welcome aboard. I'm so stoked to have you tuning in. And just so you know, we do this live stream every Friday night, typically starting at 5 p.m. Pacific time, 8 p.m. Eastern time. Sometimes I call an audible and have to change the time around. Some weeks I'm just not available either, and we skip the live stream. I hate to do that, but normal week, nothing getting in the way. We're doing this live stream Friday night, 5 p.m. Pacific time, 8 p.m. Eastern time, and hope you come back and I hope you enjoy it. And let me know if this is your first time here in the stream. I'm curious to know how many first timers we have here. Let me scroll up in the chat too with that. Scroll up to the tippy top here and see who all we got in the building. I see, let's go all the way up here. I see Striper Kid. What's going on, Striper? We've got the Danish Dividend Queen all the way from Denmark. Good to see you. Korean Cardboard's here hitting some Cinnamon Toast Crunch. Man, love Cinnamon Toast Crunch. One of my favorite cereals for sure. Always love Cinnamon Toast Crunch. Is that the taste you can see, or is that Frosted Flakes? No, Frosted Flakes are great. What's the taste you can see? Whose catchphrase is that? I think it's Cinnamon Toast Crunch. Either way, love it. Pat's here. What's up, Pat? McVeigh is here. What's going on, McVeigh? We got Chris, who went to the Eagles parade today. Nice, man. I bet it was fun. How many energy drinks, how many ghosts did you swig when you were at the parade? I'm curious to know. We got Harris in the building. What's up, man? Man, this is the first time I've seen you in the stream for a while, I think. What's going on, dude? Anthony's here. What's up, Anthony? We've got Brain Dead. What's happening? My man Zal's in the building. What's up, Zal? Striper Kid had a great. Oh yeah, and also too, let me know, guys. You guys doing anything to celebrate Valentine's Day? Anyone have any big plans? Any lonely hearts out there? Striper Kid says, took the wife out, took the bride out for breakfast, exchanged gifts, took a nap, and just got back from dinner. Nice. That sounds like a good day. Let's see. Joey's here. Shane. Sunday Sports is here. Of course, Michael's here. 85 Films still adding to SCHD every single week, my friend. Every single week. And let me show you guys actually where I'm at right now. Let's see, add the spreadsheet here. And real quick, guys, this is my dividend portfolio tracking spreadsheet. You guys can download this for free. There's a link to it in the description of the video if you want to check it out. But at this point in time, as of this week, I'm up to 346 shares of the holy grail of dividend ETFs. And my goal by the end of 2025 is to hit 450 shares of SCHD. I've noticed that on average, I'm buying somewhere between 2 and 5 shares per week. It just depends, because some weeks, because it's through M1, it's based on the weighting, and so some weeks I don't buy SCHD. Sometimes I buy both SCHD and VOO. Sometimes I just buy VOO and don't buy SCHD. But I'd say on average, I'm buying somewhere between 2 and 4 shares of SCHD every week. So we should hit 450 on the low end. With dividends reinvested too, we might even be upwards of, 500 to 550 by the end of the year. We'll see. So we might have to revise that goal upward, but that's kind of where I'm sitting right now. Anyway, Andrew's here. What's up, Andrew? We've got my man Craig here, Leroy Skywalker, SCHD Stan, the man of many names. He says, I calculated an estimate for the next SCHD dividend payment. I think everyone will be pleasantly surprised. Dude, you got to fill us in. And also, Craig, I think we've talked about this before. I know you and Russ have talked about this last time you were on his channel. When they do their reconstitution, we should definitely get like a live stream going, a group live stream, and just chat it out. That would be a lot of fun. I know that there was some talk about that, and I am in, my friend. I want to do that. We've still got couple months, right? It happens in April, or is it next month? I don't remember which one. Yeah, Brain Dead. It's going to be the best live stream because Brain Dead is here. Absolutely, my friend. Absolutely. There you go. We got Brian here. What's up, Brian? Good to see you, man. Let's see who else we got. Alien Coin Hunter, aka Alan, who logged into his new YouTube channel. Yeah, Alan, I saw that you posted a video, and let me know here in the chat too a little bit more about what you're doing. But I actually watched your video, and it has to do with coins, right? Like the video that I watched, you were finding a certain penny, right? So yeah, give us a rundown of your channel. It's really interesting. Really interesting stuff. It looked like you had quite the spread of coins in the video that I saw. Nice. So JD says, hit 100 shares of SCHD this week. Now I can do covered calls against them. There you go. There you go. Braindead, what's the email for a portfolio review? So it's not an email. There's actually a form to fill out. Let me see if I can drop it in the chat here. Bear with me. Bear with me just one moment. I don't know if I should be able to drop links in the chat here. Hold on just one sec. Let me know if you can click on this once I drop it. And if not, you should be able to just copy and paste the link. But the link that I just dropped in the live chat, that's the link to the portfolio review submission form. So if you're interested in having me review your portfolio in that monthly video series I do, just fill out the form there and I'll check it out. And just so you guys know too, I get emails quite often from people who have submitted their form, being like, when are you going to do it? How does it work? And just so you guys know, I've got at this point like over 300 different submissions, which is awesome. I'm really happy that a lot of you guys are interested in having your portfolio reviewed in one of these videos, but it's not chronological, or it's not in order from first to most recent. There's not really an order for how I choose these portfolios. It really is just chosen at random. And yeah, so I just want to apologize if it takes me some time to get to your guys' portfolios, but I really do, especially around the time when the video for the month comes out, I'll get emails from people wondering when I'm going to do theirs, and I just don't know. It's totally random, and I'll just leave it at that. Ooh, Chris, what did you do, man? What did you sell out of? Let us know in the chat. Let's see. Who else we got here, though? I see B. Wayne added some CVS. We got Tack in the building. There you go. Ooh, Jack on the rocks. Nice. Shout out Brown Foreman. Jay from Tech, 60 shares of SCHD. There you go. What is this, Tack? What is this right here? A rock? Eric? What is this? I don't think I've heard of this before. Cutters here picked up. Oh, man, look at this. Picked up some Vici and Rollins. Good job. What a combo. Let's see. Nice. Look at this, McVeigh. I hit 2 milestones, 145 shares of JEPQ and 230 shares of Realty Income. Good job. Ooh, Striper Kid with some Tito's. What are you doing there? Just Tito's on the rocks? Or what's the, yeah, Tito's straight up? What are you doing? Let's see. There you go, Zal. Water for me, alcohol free until further notice, is eating something akin to keto. There you go. Certainly low carb. I feel great either way. Nice, man. How long have you been doing the pseudo keto diet for? Is this something that you just started this week, or have you been at it for a couple of weeks? I'm curious to know. We've got Amish here. What's up, Amish? Or Amish, maybe? Maybe it's Amish. Let's see. Nice. Amish, first time live. There you go. Let's see. Fishy Man's here. What's going on? Let's see. Let's keep going. Patrick's here. What's up, Patrick? Sipping a Monster Zero. There you go. A white monster. Well, maybe it's not a white monster, but could be. Wubs is here. Ooh, EPD payment today. Did I get that? I don't know. Sometimes it takes, I don't know if the payments hit for my account. Let me look real quick. Hit up Schwab. There we go, guys. Good day of dividends. Let me show you. See if you can see this, if it'll focus in. Show you what we're doing here. So we got AbbVie, EPD, Realty Income. What's that one right below it? Can you guys see that? Main Street Capital Corporation. There we go. Looking good. So yeah, 60 from EPD, 16.5 from AbbVie. So we're at about 76, 28 from Realty Income. So that's over 100, 104. And then 14 from Maine, 104 plus 14. So almost 120 bucks for the day just from dividends. That is, that's crazy. Holy cow. Holy cow. That's crazy. Okay. Teeps is in the building. What's up, man? Good to see you. Let's see who else we got. Anyone else's birthday? Is it someone's birthday? Did I miss someone's birthday? Let's see. Jack on the rocks. There you go. Oh, I think I'm a little bit behind in the chat now. Sir Dude Bro Man, what's going on? Alex is here. What's up, Alex? We got Jay Toyster. What's going on? Blair's here. Ooh, Blair says, and maybe we talked about this in a previous stream, Blair. I don't remember if that was you or someone else. At some point this year, I should have a very large amount of money to invest in my portfolio. Looking forward to that for sure. Thieve is here. What's up, Thieve? Finally made it live. Josh is here too. Hey, Josh. Okay, the reconstitution is March 21st, goes live the 24th. Cool. Awesome. Henry's here. David's here. Nice. Very nice. Thieve, what are your thoughts on FSKKR as a BDC? Is that one BDC or is that two BDCs? Because I'm not, oh, it's one company. FSK is the ticker symbol. I see a negative 5-year growth rate on the dividend. So that's not great. But it looks like, here, let me show you guys. Just pull it up on Seeking Alpha real quick. Let's see the total returns. Nice share price returns in the last year. Let's compare them to, let's add like Main Street in there. Let's add Blue Owl. And let's add Aries and just see how it all compares. Not bad returns. Wow. Yeah, not bad returns at all in the last year. Yeah, pretty good. Even despite, and I'll show you guys what I was seeing with the dividend. I would say that these returns look pretty good. I don't know anything about the company. I'd have to spend more time with it. This was one of the first things I noticed. They have a negative 5-year growth rate, but it really doesn't look to be too bad. Looks like there was a cut here in 2020, also a stock split as well. But since 2021, they've increased the dividend again. So, oh no, they did cut it here. They did cut it here by 5 cents. So, yeah, I don't know. I don't think that's the end of the world. I mean, obviously, a dividend cut is never good. And it seems that they've had a couple of them in the past 5 years. So, their track record of maintaining that dividend is not the best. The total returns, despite that, have still been pretty good. So, I guess I'm on the fence. And I would say that just because of the dividend cuts alone, I would still opt for something like Main Street Capital Corporation that has a much better track record of growing their dividend. They did cut it in 2020 as well, but it's really come back with a vengeance. So I probably would still opt for something like a Main Street, but it doesn't, just from the returns, the brief few seconds I looked at it, it doesn't seem to be all evil. Trevon, what do you think of Zoetis? It's down a lot today. Is it down a lot today? Let's take a look at, well, you know what, Trevon, I'll save this. We'll circle back to it. I was actually, I was just looking at Zoetis last night because Seeking Alpha now has these like AI generated summaries of the earnings calls. So I was reading through that. It seems like they had a really solid 2024, which is no surprise. They're expecting a really solid 2025 as well. And like continued growth with Librela, which is one of their main drugs. And then there was another one, starts with an S. I don't remember the name off the top of my head. But yeah, I'm still hyped on Zoetis. I hope it keeps pulling back. That one's still really high up there on my watch list. So David said almost 100 shares of Clear Secure. Yeah, that one's, it will, Trevon, we'll go take a deeper look at Zoetis too. We'll check it out on Snapstock here because it's been a while since I've looked at it. So we'll do that in just a few moments. Clear Secure saw a crazy drop today. When I checked it out earlier today, it was down something like 6% for no reason whatsoever either, by the way. There wasn't any news. There wasn't anything that brought the share price down. It's just been doing that. And I'm really interested to see what happens with Clear at the end of the month because they're reporting their earnings, I think, on the 24th. And yeah, I'm just very interested to see what comes out of that and how the market responds to it. So it's now at about $22-ish per share. It's like $7 below my average cost per share. And I'm getting to the point where it's like, okay, I probably really should start going a bit heavier into Clear, but it's been kind of a falling knife. So I'm kind of watching it to see where it bottoms out before I start adding to it again. In the meantime, I'm adding to things that I know to be a bit more stable and less volatile, like Vici and Johnson & Johnson. So, but David, like pretty cool milestone there with that close to 100 shares. Joey was using GetQuinn and switched to Snowball. Can we submit that format? Yeah, absolutely. Totally. Totally. Robert, what's your opinion on Coca-Cola and why did I sell it? I'll circle back to that. Good question. Investment KD, what's going on? Portfolio's been good, my friend, sitting in all-time highs, and I hope the same is true for you. Okay, let's see. I'm about 10 minutes behind in the chat, guys. So I'm gonna just scroll down here quickly, see if there's any questions. See what questions I can pull, excuse me, and Adam. The Magic and Hockey's got a good question. I'll circle back to that one. Josue, it's like first time in the stream. What's up, Josue? Happy to have you, man. Hope you're doing well. Ooh, Jana's finishing up a burrito bowl. That sounds delicious. Delicious. One for all, thoughts on UNH. This is a super quick one. I'll just answer this one right now. Seems like a great business. I don't know enough about insurance companies to really feel comfortable enough to invest in them myself. So I tend to stay away from them, but it's been a really solid grower, and the total returns from UNH historically have been very, very juicy. So yeah, that's about my as far as my opinion on it goes. Thoughts on Ford Motors? I don't really like the idea of investing in car companies. Ford is obviously an iconic company, but I think there are plenty of better investments out there. There will be times where you'll make money on it, like just like with a lot of other securities, but I think generally there's better businesses to invest in. Jana, would you mind taking a look at UNP tonight? Yeah, we'll check it out. I haven't looked at Union Pacific for quite some time. So, Skulk, what's going on, my friend? Thoughts on AES? What is that? I feel like we just looked at this one last week. We'll check it out. What even is this company? Oh, it's a utility company. We definitely looked at this. We definitely looked at this one last week because I remember saying it was either last week or 2 weeks ago because I remember looking at it and saying I probably would rather invest in something like Southern Company or AWR, American States Water. So I remember we did look at that one. Okay. What is the meaning of life? That's funny. I don't know. Let me know what you guys think. That's a pretty heavy question. Let me know what you guys think. Thieve here, thank you for the $5 super chat. That was super nice of you. Grandchild has for answered mi pregunta, my question. If I submit my portfolio, do you want the 403, IRA, and pension? Whatever you'd like to share, my friend. Whichever. I think it would be easiest just to review one portfolio instead of all three. So I probably would prefer just to do one out of the three if you don't mind. But maybe between the 403 and the IRA, whichever, just pick one to share and I'll go through it. And also you can also add some context in the notes about the other accounts and I can take that into consideration as well. Alex wants to know about Clear Secure. We'll take a look at Clear Secure too, if it's a good buy. Okay, guys. So looks like I've got 6 good questions saved here, and we're going to go through them one by one. Yeah, we'll go through them. Actually, five questions. Sorry, one of them was the super chat from Thieve. Sir Dude Bro Man. Funny comment right here. That's funny. Investment KD at which point Lockheed Martin. So let's take a look at Lockheed Martin too, because it's been a while since I've checked it out. So we'll see what the valuation's looking like, see what the free cash flow yield is and all that stuff, and maybe we'll see what looks good. So okay, Trevon says, what do you think of Zoetis? It is down a lot today. So I kind of touched on that a few moments ago. Zoetis is a stock that's pretty high on my watch list. I really like the company. And if we look at the financials, I think we'll also find a lot to like about it there as well. And by the way, guys, well, let me take a step back. In case you've never heard of Zoetis, this is basically it's a healthcare stock. They make veterinary pharmaceuticals. So they make pharmaceutical drugs for cats, dogs, livestock, chickens as well. And they are like the biggest company in the world to do it. But their bread and butter really is like cats and dogs, so household pets as well as livestock. And on that note, on the topic of pharmaceutical companies, I'm almost done with this book right here, guys. It's called 10 Drugs by Thomas Hager. How plants, powders, and pills have shaped the history of medicine. This has been a really, really, really interesting read. And I've learned a lot about I thought this would be like a good primer for learning more about how pharmaceutical companies work and the history of them and stuff like that. And I've not been disappointed by this book. I got to learn about how companies like Bayer and Merck and Pfizer got their start. I got to learn about like the origins of certain drugs such as heroin, which was first made by Bayer, which interestingly, Bayer, before it was a pharmaceutical company, a healthcare company, they made garment dyes, and they would take coal tar and extract chemicals from the coal tar to make certain garment dyes. But then they realized that they can take um, other molecules from these coal tars and extract them and turn them into pharmaceutical drugs. One of which was like a synthetic, like the first actually, I think, synthetic um, like opioid, I should say. So, and there's a difference between the two. An opiate is something that's derived naturally from opium, whereas an opioid is synthetic, so completely made in a lab. Interesting. So anyway, long story short, it's just been pretty insightful read, and it's a really easy book to read, and it's fun. It's actually been a fun read too. And so I'd highly recommend it to any of you guys. It's not really like a, an investing book necessarily, but you'll learn some things that you can apply to these types of companies. So anyway, tangent over there. I think we now need to take a drink because I talked about a book unprovoked. That's part of the rules. Okay, but let's get to Zoetis. I'm sorry, guys. So going over here to Zoetis, looking at Zoetis here on Snapstock. Let's see, what's it done today? So it's down 4.7% today. It's had a pretty big drop. Oh, in the last month, it's down 5.5%, including the drop from today. So that's pretty heavy. And it's gone from mid 170s to wow. Okay. You know what, too? I want to get my calculator out and see. So 157.52. Okay, so let's see what I'm just going to do some dividend math real quick. So 157.52. So point 1.18. Okay, that's the yield. And the free cash flow yield, 2.25. Where's the free cash flow per share? So let's do this right here. So 5.06 divided by 157.52. So free cash flow yield is really like 3.2, which is going to be quite a bit above the average, considering this is already above the average. So the valuation's not too bad. I remember when I first started talking about Zoetis, it really wasn't too far off from where it's heading. It was about here, I think, that I really first started talking about it when it was in the 140s, and it's quickly getting back down to that. We'll see if it gets down there. But anyway, scrolling down, looking at the financials, looks pretty good. As we can see, it's been a pretty good growth trajectory here in the financials. Nice revenue growth, almost 8.5% revenue CAGR over the last 5 years. Earnings per share, double-digit growth CAGR here. Free cash flow per share has been pretty juicy, almost 10% there. So that looks good. Really nice and high margins that are actually slightly expanding over time. Looking at the gross margins, the net income margin has definitely expanded, so that's great. And I'd say the free cash flow margin here has been pretty steady. No debt either, actually. Negative net debt, I should say, which means they have more cash on the balance sheet than they do debt. So that's great. Interest coverage historically is very strong. So good looking balance sheet. And as we saw, the yield is a bit above the average right now. So the average yield, it looks like, is about 0.7%. And I'd say right now it's about 0.5% over that. And look at that dividend growth rate, guys. According to this, 21%. That is very, very nice. And they also have, this is one thing to keep in mind too, guys, actually, is these payout ratios. So with that, the payout ratios have increased over the years very consistently. And so this is something that you'll want to keep an eye on. It's still in fine shape, but it has gone from, it's basically doubled, going from 17 to 31.6% over the last 5 years or so. So definitely keep an eye on that. Still the payout ratio is not anything to be concerned about, but if this trajectory keeps going, that it will become an issue at some point in time. And the same is true here with the free cash flow payout ratio. Still, it's in good shape, but just keep an eye on it. Now, with that, looking at the returns here, the return on invested capital historically has been in the high teens. Looks like 2024 here, very high. But otherwise, we can say this looks to be kind of an anomaly year. But otherwise, we can say high teens return on invested capital. So that's not too bad. Really steadily increasing return on assets, which is looking good, and high returns on equity as well. So like I said, financially, there's a lot to like about Zoetis. It's kind of a unique pharmaceutical compared to some of these other ones, like a Pfizer or a Merck or a Bristol Myers or J&J, you name it. It's just different in the sense that they sell their drugs they make their drugs for animals. And if you go look at their investor presentations, they'll talk about companion pets basically as being part of the family, and it actually being a very resilient business to get into, because pet owners these days, because they consider their pets to be part of the family, and I can certainly tested this with Peanut. No, he's not even in there. People think of their cats and their dogs as being part of the family, and they're more likely to spend whatever it takes to get them the care that they need when they do get sick. Whereas, if it's like us, us humans, and we have something wrong, we might tough it out. We might not go to the doctor. We might not, get a medication for ourselves if something were to go wrong. But if there's something going wrong with your pet, you're going to spend whatever's necessary to help them get better. That's what Zoetis has found. And so anyway, it's a really interesting business. Obviously, qualitatively, there's some competitive advantages. Quantitatively, it's looking really good too. So I'm pretty hyped on this business. I don't know exactly what I'm waiting for when it comes to adding it to the portfolio. I don't know, guys. Let me know if you feel this way too. Maybe I'm thinking about this weird, but I just don't know that I feel like adding a new position right now. Um, Now, if Zoetis keeps going down, I probably will, because it has been on my watch list for a while now. And I think if I see it just keep going down, I'll probably end up starting a position in it. Um, but we'll see. I'm not in that much of a rush to do so, which is why I'm saying, it's a good business, but since I'm not in a rush, if it just becomes too good of a deal to turn down, then I'll add it. But otherwise, I'm pretty content with where the portfolio is at. Do you guys ever feel the same way, or am I kind of weird for thinking that way? Let me know your thoughts. Oh, thanks, Charles. Did I say it was my brother's birthday? I must have said that earlier in the stream. I must have, right? Oh, gracias. Gracias, not grandchild. Personal brokerage. Got it. There you go. Gracias. Ah, de nada. Claro que sí, mi amigo. Okay. Mm-mm-mm. So intercomposed, is there a forward-looking free cash flow yield metric? I believe it's backwards looking. Yeah, I mean, I was just doing it using the trailing 12 months. I was using it looking a backwards looking metric, but you could calculate the forward free cash flow yield using a forward free cash flow projection, and that would give you the forward free cash flow yield. You know what I mean? Let's see. Late game hero with RFK Jr. And do you think healthcare pharma stocks will be on sale soon? I don't know, actually. I could see a situation in which they see a negative reaction to that. But I don't know. I don't know what will happen. I really don't. Good question. Good question. Gary, yes, I have maxed out my Roth IRA. Thank you. Thank you for asking for 2024. Okay. Ken, really good question, Ken. I'm going to save this and circle back to it. We'll go back through. Oh, Darren, happy belated birthday, my friend. Okay. Anthony, good to see you, man. I'm glad to hear that you've been staying busy, and congrats on hitting 100K in the portfolio. That's awesome. Okay, guys, let's go back to this next question here. This one's from Robert. What's your opinion on Coca-Cola, and how come you sold your position? So Coca-Cola undoubtedly is a steady, stable, stalwart business. No doubt about that. And I think it's a fine one to own. I ended up selling out of Coca-Cola for a few different reasons. First and foremost, it gotten to the point where it became a pretty small position in my portfolio, and like to the point where it really wasn't going to move the needle much in the portfolio. And like I said, it's a pretty steady, stalwart defensive position, which is fine. Like, I'm happy to have those in my portfolio. But another reason that I sold it is because just taking inventory of things, I had other positions that filled that role for me, other larger positions that I liked more that filled that role for me. I'm talking about stocks like Procter and Gamble, Johnson and Johnson. Altria is there. Realty Income for sure is there as well. So I just had other defensive positions that I think played the same role that I saw Coca-Cola playing in my portfolio. So I just felt that I didn't really need it, and I could unlock that money and put it to better use. And I'd seen a pretty decent gain with Coca-Cola too. Let me see. What was actually my total return here? Let's jump back over to the spreadsheet, guys. Let me show you. So going over here, it looks like my total return with Coca-Cola upon selling it, I was up 34%. Okay. So not too bad. And like I said, it really wasn't a big position of mine. I only had 23 shares, average cost of $51 per share. So I had just over, I don't know, what is that, including the sale price? Maybe $1,200, $1,300 invested in it, somewhere in there. So maybe more, actually, maybe like 1,400 or 1,500. But either way, not a huge position. So I was okay letting it go. And then I don't remember what I reinvested into. Maybe I used that money to buy Vici Properties or something like that, which I think was a good move. So yeah, that's pretty much my story with Coca-Cola. I don't have anything against it. It just I had other stocks that did what I wanted to own Coca-Cola for. And with that said, too, let me just note too, I like having, sometimes I'm given a hard time for owning things like Procter and Gamble or some of these quote unquote old man stocks like the Procter and Gambles or the J&Js or whatever. But I think it's important to have some defensiveness in your portfolio. I think when things are good in the market, it's easy to think that things will only go in one direction because it's easy to forget that about, the other thing that can happen. But in times where stocks are going down, it's good to have some defensiveness, and it's good to have things that can add some downside protection. And when you combine that downside protection with still, respectable appreciation on the upside, you could end up with overall solid outperformance. And sometimes I think this is taken for granted or not quite given as much attention as it should. But the thing that could deliver that outperformance is the downside protection, which will come from these defensive positions. So like I said, I'm given a hard time sometimes for owning certain stocks like that are kind of steady, stalwart, slow growers. But they play an important role in my portfolio. They may be on the bench right now because the offense is on the field. But they will have their day. And I don't know exactly when it will happen, but I'm glad to have some of those in the portfolio, Hopefully that makes sense. You guys will have heard me say before, and maybe I already said it in the stream, but I like having what I consider to be an all-weather portfolio that has a mix of everything, that has a balance of everything for that reason. So, Zal, that's funny. Move the needle should be part of the drinking game. That's funny. That's another thing that I say quite a bit too. Move the needle, not too shabby. Maybe I need to make some t-shirts that say not too shabby. That'd be funny. Some coffee mugs and stuff. Um, okay, so let's move on. This next question comes from the Magic in Hockey. Are you just investing in dividend-paying stocks? Yes, I'm just invested in dividend-paying stocks, and let me break that down a little bit more. It's funny that you asked that. I was actually talking to my best friend Bob on the phone this morning. Bob and I have been best friends since kindergarten, literally. So 20, probably 26 years he's been my best friend. And he was talking to me today about, he's getting to the point where he's finally ready to start putting some money in the market. He says this year one of my goals is to start investing. He says he wants to pay off some debt first and put himself in a better situation financially before he kind of adds that commitment to his plate. But he asked me that same question. So do you just buy dividend stocks or what does that look like? And as far as the individual companies in my portfolio, they're all strictly dividend payers. But I also have my Roth IRA where I dollar cost average into SCHD, obviously dividend payer. But also the S&P 500, which yes, does pay a dividend, but it's not really like a dividend ETF by any means. So yes, I only invest in dividend paying assets, but not all of my stocks are like what you might think of as dividend stocks. And that's what I want to break down a bit more because there's this, I guess there's this, what do I call it? I guess it's a belief. There's this, I kind of want to call it a misconception. Maybe I don't, but it kind of is. There's this misconception about dividend investing and dividend stocks that they have to fit like um, a certain mold. And a lot of people will say too, like when it comes to Visa, that's a good example. People will say Visa's not a dividend stock. Visa has a less than a 1% yield. Microsoft has less than a 1% yield. It's not a dividend stock. And while I understand that sentiment, I don't agree with it because it pays a dividend. So by definition, it is a dividend stock. It is a dividend paying stock. And so I think that's an important distinction to make. And that's also to say that just because I only own dividend stocks, that doesn't mean that I'm subjecting myself to a life, an investment journey of subpar returns. I think that there's also that misconception that if you buy dividend stocks, you're guaranteed to underperform the market and you're not going to see growth. And that's just not the case whatsoever. And so when I talk about being a dividend investor or when I talk about buying dividend stocks, I mean I'm buying only dividend paying stocks. Like in the same way, it doesn't have to be a certain yield, it doesn't have to be a certain growth rate, because it can vary. But in the same way that I want to invest in companies that are growing their sales, in the same way that I want to invest in companies that are profitable and growing their free cash flow and have, manageable debt loads on their balance sheets, in the same way that I look for that as part of my criteria, I also look for the presence of a dividend. And to me, that's what being a dividend investor is all about. And dividend stocks can come in different shapes and sizes. You've got your high yield stocks like the Realty Incomes or the Altria Groups or Main Street Capital Corporations, which interestingly enough, has seen just crazy share price appreciation in the last year too. So they can grow too. Same thing with Altria actually. But anyway, you've got your high yielders that maybe don't have, a lot of growth, dividend growth with that. And I think that's what most people think of as dividend stocks. And it's that plus the Procter and Gamble's and the Coca-Colas. They think of them just as these old man stocks, but there's such a spectrum. There's those high yielders. Then you've got the J&Js that are kind of in the middle. They have a moderate yield, moderate growth rate. And then you've got the Visas, which are the low yield, but crazy dividend growth, and going back to building an all-weather portfolio, I like to keep a mix of all of those in the portfolio. And so when it comes to dividend investing and being a dividend investor, that's what it means to me. And yeah, I just think there's a huge misconception. One of the biggest misconceptions about dividend investing is that you can't see like suitable total returns from investing in dividend stocks. You're only going to underperform. It's just not true. It's just not true. So anyway, hopefully that answers your question. I know that kind of took a left turn and went on a tangent as it sometimes does, as it often does with me. But that's an idea that I've really been thinking a lot about these last handful of months because I see it all the time. And I think it's easy to put investors or stocks into certain buckets or certain categories, but it's easy to forget that there's a lot of gray area and there's a lot of nuance that comes along with this that maybe it gets left by the wayside when it comes to leaving comments on YouTube videos or stuff. It's easier to do that. So anyway, and hopefully all of that makes sense, guys. That's the thing too. This is a good point, Sir Dude, bro, man. Not to continue being a dead horse, but this is a good point. When you think about it, especially when it comes to like dividend growth stocks, which are categorized by lower starting yields. Visa is a good example. Lowe's, Snap-on, Williams-Sonoma, Microsoft, lower starting yield, high dividend growth. The only companies that can continue to support that type of dividend and that type of dividend growth are the ones that are consistently profitable and growing their profits and free cash flows. And at the end of the day, like, aren't those the type of companies you want to invest in anyway? So I do think the two go hand in hand, and that's another reason why I want to stick to just dividend payers. So I like getting that dividend as part of my total return. So I like having at least some sort of, I guess, cash-based relationship with the businesses that I own. Russ, what's up, man? There you are. Russ is in the house. Matt's here too. What's up, Matt? Good to see you, man. Good to see you, man. So dividend investing filters for profitable companies. Yeah. And then on the other side of that too, when it comes to when it comes to like growth stocks or quote unquote growth stocks, it's like, well, what does that mean too? What is a growth stock, and what is a value stock? It's so easy to label these things, but and I guess like the only reason I label a dividend stock is because it's characterized by the presence of that dividend. But it gets a little fuzzier now that I'm thinking about it. When you think about growth stocks or value stocks, it gets a little bit fuzzier to put those into a certain bucket, because some dividend stocks can also be growth stocks and vice versa. You know what I'm saying? So it's kind of interesting. Okay, guys. But anyway, I enough of a tangent on that. We've got a few more comments to get to. This next one's from Jana, who wants me to look at UNP. Been watching for a price drop. Yeah, let's check out Union Pacific. Like I said earlier, it's been a while since I've checked out that company. So let's see what's happening with UNP over here on Snap Stock. Okay, so it looks like in the last year, they're up about 3%. Free cash flow yields coming in at about 4%. That's not bad. Dividend yield looks like it's a bit above the average. I'd say it looks like it's about at its average valuation right now, right? Just looking at these charts here, it's pretty in line with where it historically trades. Nice. So revenue growth, yeah, this is looking pretty good actually. The 10-year revenue growth, pretty flat, only about 1.2%. But the bottom line's growing at a pretty aggressive rate. Like even without these years right here, which are definitely high and mighty, the earnings per share trajectory is up and to the right. So that's great. So the company's becoming more profitable over time. We'll see that reflected in the margins in just a moment too. The free cash flow per share has been really nice too. Really nice growth here. Yeah, so gross margins have been steady, maybe even slightly increasing. Nah, not really. Net profit margin slightly increasing, it looks like. Free cash flow margin was up until 2020, and since then it's been, it's had its ups and downs, but it's still in decent shape, decent spot. Debt situation looks okay. The net debt to free cash flow, 5.3. It's kind of like on the fringe of the upper end of where I'd like to see it, about 5. But yeah, I guarantee this is pretty much all long-term debt. I'm sure most, if not all of it, is long. No, I'm sure there's some short-term debt, but yeah, this looks fine. Interest coverage, decent shape. It's about 8. It's fine. The yield looks a bit lower. No, I guess it's right in line with the average, huh? Man, 2015, it was really high. Holy cow. So yeah, I'd say that it looks pretty fairly valued. The last couple of years of dividend growth have not been that great, but 2020 to 2022 were really nice. So the dividend growth has really slowed down. But the payout ratios have been pretty steady, so that's good. Returns on invested capital aren't anything out of this world. I mean, double digits, that's good. That's fine. But I think that I think there's probably better choices out there. What's like Canadian Pacific looking like? What are their returns looking like? Just out of curiosity. So their returns aren't as good. Actually negative. What's another railroad? I know I'm missing one. And Norfolk Southern. Norfolk NSC. I couldn't remember the ticker symbol. Yeah. So not great margins in any, or not great returns on invested capital with any of these railroads. But probably shouldn't expect that. I mean, at this point, these companies are just so big. You're not really buying them for the growth. It's more so for the stability, I'd imagine. And while we're here talking about industrial stocks, it'd actually be kind of interesting comparison to switch to a different industry and take a look at LMT, like Investment KD wants us to do. So let's do that real quick, and then we'll check out Clear Secure. So yeah, UNP, I mean, seems like a fine company to own. You know, definitely like a defensive one. So if that's what you're looking for, I wouldn't have expectations that it's going to be like a tremendous grower, but I think it's probably a steady one. Patrick, great question. Great question. I'll answer this one. There you go. Paolo, man, I hope you're having a good workout. What are you hitting tonight? Good on you for getting that done on a Friday night. Proud of you, man. Okay, guys, so Lockheed Martin. Big drop in share price. Wow. I sold this one a while back too. I ended up selling LMT at $4.91 per share. So yeah, wow. And this was back 2 years ago, just over 2 years ago. So wow, they've really seen a strong pullback since October, huh? Looks like with that, the PE ratio is still a little bit above the average. Free cash flow yield's not bad though, at 5.25. That's the highest that we've seen so far tonight, I believe. But it is about 10% below the 5-year average. With that though, the dividend yield is about 12% above its 5-year average, so that looks good. Yeah. But so you asked though, at what point is Lockheed Martin too cheap to ignore? I don't know. I mean, it still looks like it has some ways to go. It saw a really tremendous run up in July. This is crazy to see what it did. So let's see. Yeah, I don't know. It's really not a bad price right now, I would say. What's the 10-year treasury yield? So 4.5. You know, you could probably buy it at about a 5.5 to compensate for like the risk premium. Probably a 5.5% free cash flow yield, about 1% above the 10-year treasury. This is how Terry Smith does it. He uses the free cash flow yield as his preferred valuation metric. And his rule of thumb is for like an acceptable valuation is when the free cash flow yield is about 1% above the 10-year treasury yield. So right now, 4.5%. You might want to buy it when it's about 5.5%. So let's see, that would be at free cash flow per share. So 22.17 divided by 0.055. That would be at about $403 per share. Is when the free cash flow yield would hit that 5.5. So if you're following Terry Smith's rule of thumb, you've got about $20 to go before it gets there, which is not too far off. That's another 5% drop from here. And if it has another couple of days like this, you'll be there. So, but still, I don't think it's a bad time to start dollar cost averaging into Lockheed Martin if you wanted to add it to the portfolio. So, yeah. Chupa with the $5 super chat. Thank you, my friend. Okay. SPLG. Let me go back over here. And we'll get back to the other questions after this. I think we'll end up going a little bit longer tonight, guys. So SPLG, SCHD, VXUS, VIG is my Roth mix. Your thoughts, tips, heavy on SPLG and SCHD, new investor. Nice. Well, I would say that generally speaking, Chupa, you're off to a great start. I like the fact that you went all in on ETFs as a brand new investor. I think that's the way to go. If you ultimately decide to get deeper into the weeds with it, at some point in the future, that's fine. But I'm glad that you're kind of starting with this diversified approach. It's kind of like walking before you run, and some people decide they like walking. They don't need to start jogging or trotting or sprinting or whatever. They're good just taking a casual walk around the block with this investing stuff. So with that said, I'm happy to I think you're off to a great start there. SPLG, SCHD, I think that's a great split. Even VIG in there, I think is good. VIG is the growth ETF, right? Or is that the dividend appreciation one? I think that's fine. I don't know that you necessarily even need two different ETFs, dividend ETFs in there. So I think you could get by. What are the top holdings in this, actually, before I continue on? So Broadcom, Apple, Microsoft. Let me show you guys. Broadcom, Apple, Microsoft, JP Morgan, Visa. You're gonna get a lot of these in, well, at least the first three there. In SPLG is the top 10 too. So that's another thing to keep in mind. Some of these are also going to be in SCHD as well. So you might be double dipping with some of these holdings, but and what's even the dividend stats here? Yeah, 1.65, 9.63. I don't know. I kind of look at these dividend stats and I think, man, you're getting more from SCHD in the dividend department than you are in VIG. So I don't know. I don't know if you weigh that into your decision at all, but ADG. I think I'm missing something in the chat here. What name are you guys talking about? Is it this one? Is it this name? I don't know. Maybe I'm missing something. I don't know if that's a bad word in Spanish. I apologize if it is. Yeah, I don't know what that means in Spanish if it's a bad word. So I apologize if I'm saying some naughty things. But anyway, back to what I was saying. I think you could get by not having VIG. It's not going to kill you if you have it in there as well. VXUS for international exposure. I think that's fine. So overall, like it looks like you've got a pretty well-rounded portfolio, actually. I think it's good how it is. Yeah, I think it's great, actually. So yeah, good job, my friend. Keep up the good work. So yeah, like I said, okay. Okay, I didn't know that. Did not know that. Thank you, Zhao. for letting me know. And I apologize for the bad words, guys. Getting me in trouble, Chupa. You're getting me in trouble, my friend. This is a family friendly show. And with that said too, I mean, you say this, but don't get rid of VIG just because I said to. I mean, obviously do whatever you think is best, but I think you could make the argument either way. I really do. So yeah, sorry for the bad language. I didn't know that that was bad, guys. My bad. My bad for being bad. Okay, so Alex here, clear secure, a good buy now, especially at local low. Yeah, let's check out Clear. So Clear Secure is kind of an interesting one, right? Let's go back over to Snapstock. This one just, yeah, like I said earlier, guys, 6.4% drop just today. No reason whatsoever. Just decided to go down. With that though, like, look at this, 11.5% free cash flow yield. Really nice dividend. And this one's, I would say that out of all of the companies in my portfolio, this one is probably the yeah, so yeah, this is funny. This one's probably the most speculative position in my portfolio. It definitely is a departure from the Procter and Gambles and the J&Js that I own. But still, Clear Secure is a tremendous grower, crazy revenue growth. They are now profitable, crazy earnings growth now, crazy free cash flow per share growth. Crazy, crazy, crazy. Really, really high margins and increasing as well. No debt on the balance sheet either. And they pay a dividend. It's unusual to see a company. Sorry, I'm reading the chat now. It's unusual to see a company at this stage in the life cycle already paying out a dividend. And I just look at this company and I think it's such a solid grower so far. And they're expanding into some pretty interesting areas. They're expanding beyond airports, working into healthcare and consumer stuff and whatnot for identity verification. And so I just think it's a really interesting business. I kind of added it on I don't want to say on a whim, but I definitely added it very abruptly, much quicker than I've added any other position. And I will say, while I do think the company is good and I'm happy to own it, I definitely feel like I jumped the gun in adding it around here. Now, for a short period of time, it was a good move. Like it went up another 20-25% after I bought it. But as we can see, it's clearly come back down and then some from that. So with that said, I think this is a really, really interesting business. It does have some risks, Right now, a lot of their revenue is coming from airports. So they are reliant on that. And there is some stuff that can go wrong with that, travel trends, people not traveling as much, or regulation risk as well could come into play here. There are some things that can go wrong with Clear Secure. So I think that I think there's some more uncertainty with this business than there are a lot of other ones out there, Hopefully you'll be rewarded for taking on that risk. I mean, based on the trajectory of the financials, if this continues, then I think it will be a good one to own, but that's a big if. So anyway, and with that said, I knew that going into it. Right now it's only about 3% of my portfolio, so I'm kind of being careful with it. I'm kind of trying to, I guess, hedge my bets a little bit. And I'm very interested in buying more at its price now. And I'm very keen to dollar cost average down on it and lower my average cost on it. But at the same time, I do think that there is some uncertainty with this business. And I also don't want to go too, while I feel good about it now, I don't want to go too heavy into it in case I end up being wrong. And I could be very wrong about this investment. Time will tell. So we'll see what happens. Like I said, this one there's just, I mean, I guess just like any other business, there's things that can go wrong with it. So we'll see what happens. It's a very fast changing industry too, which is something that plays into that uncertainty. Okay. Aussie Dividend, does it show companies on foreign stock exchanges? So not at this time. It's really only working with stocks that are listed on the New York Stock Exchange. Like, for example, if I wanted to pull up Aritzia, which is a Canadian company right here, I couldn't pull up the Toronto Stock Exchange listed version of it. I can only pull up the Pink Sheets version of it listed here in the States right here, you know? So that is one of the shortcomings. Hopefully that makes sense. Okay, so let's keep going to some of these other questions, though. So this next one comes from Ken. Hey, Ryan, when you pick your stocks, do you use fundamental analysis? If so, what are factors that solidifies a decision to whether you may pick a stock or not? Thanks in advance. This is a good question, Ken. And I think I might save this one for a future video because this is good. And I've answered similar questions in the past. I think basically what you're asking is like, what do you look for in an investment? And just to give you a Spark Notes version of it, the first thing that I come to understand is like the first thing that I look for and try and figure out is, do I understand how this business makes money? Like, can I wrap my head around what they do? And like, if I can check that box, that's a big one. If I can't, then it's probably not one that I'd be interested in investing in. And so that's the first place that I think you should start when doing your analysis. And all of this stuff goes into fundamental analysis, by the way. The next thing that I look for, if I've got a business that I understand, like let's actually give like a good example, okay? Let's look at Domino's Pizza. I think that's kind of an interesting example, okay? So obviously for a simpleton like myself, I can understand how Domino's Pizza makes money. They make pizza, they sell pizza, people eat the pizza, and Domino's makes their money. So once I've established that, then I go look at the financials. And this is why I like Snapstock. It's a good way to get like a quick rundown of a company's financials. It's the tagline is deep insight done instantly. So just at a glance here, I can really learn a lot about the trajectory of this business and their margins and debt and stuff just from looking at these few charts, a quick scan. This is always the next thing I do. If not the first thing. And so I can look at this and be like, okay, I like this. This is exactly what I might be looking for in an investment. This is clearly a growing business that continues to increase their sales and their profits and their free cash flow over the years at a pretty aggressive rate. So it's like, that's another pretty big box checked. Okay. They're doing so while also becoming more profitable over time. That's a really good sign. If it was going the other direction, if it was going down over time, then that might be a bit concerning. Like if we look at Walgreens, for example, is an example of a business whose margins are going down over time. Gross margins, clearly, we can see it here. I might look at that as a red flag, right? But if I look at going back to Domino's, if I see something like this, then it's like, okay, this all looks really good. The net debt to free cash flow is a bit high, 10.5. So that's higher than where I'd like it. Interest coverage ratio too is pretty low at 4. I'm going to use the Kevin Burgess rule of thumb for the interest coverage at 8. So based on Kevin, I trust Kevin with my life. I learn a lot from Kevin Burgess. He's the man. And so by his standards, this would be a bit low. Maybe not a deal breaker, but yeah, something you'd want to take into consideration. Dividend stats, okay. And as time goes on, this is kind of a good lead in into Patrick's question, which I'll get to in just a moment. But as time goes on, I really put less weight on the dividend stats. Like I was kind of mentioning earlier in the stream, what's important to me more than anything is the presence of a dividend. Now, how high the yield is, how high the dividend growth rate is, we'll get to that, but if a company pays a dividend, that's a big box checked. I don't really like to invest in companies that are like low yield, low dividend growth. I mean, if you see something with like a 1% dividend yield and like a 2 or 3% dividend growth rate, I don't know that I'd want to get into that. I think there's other places I could put my money. But when you see something like this that has a low starting yield, 1.25%, that's not that exciting. But looking at the dividend growth rate, on average over the last 5 and 10 years, it's pretty close to 20%. It's like, yeah, that's pretty meaningful to me. So it's like I can get on board with that. And furthermore, look at these returns on invested capital. The 5 and 10 year are coming in at like 60%, which is just insane. So anyway, I take all of that's kind of the next thing that I'll look at when it comes to analyzing a business, is what do the financials look like? If it's something like this, then it's like, yeah, okay, I should at least keep an eye on this one because there's something to this business that seems to be good, or else it wouldn't be growing as much as it is. And I would say that those are kind of like the two big things that I use to determine if a business is at least worth keeping an eye on. And then, you got to spend some time like chewing about it a bit more, or chewing on it a bit more. Once you know how they make money and get a sense of the financials, you have to think about what's driving that. Like what is it about this business that is allowing it to grow so fast? And what do the next 10, 20 years for this business look like? And also, like, what does the management team need to do or continue doing to make sure that long-term vision comes to fruition? From there's just kind of a lot of thinking and chewing on things, and also just kind of weighing that against the holdings that you currently own. Are there better places to put your money right now? Is now a good time to buy Domino's based on the valuation? There's just kind of a lot that you have to think about from there that you can really get into the weeds on. So hopefully that answers your question. Like I said, that's kind of a Spark Notes-ish way to answer that. So yeah, Scorpio, man. I get this all the time. Christian Eriksen. I think isn't he on Manchester? I don't know a lot about football, but yeah, I get at least 1 or 2 comments a week. People calling me that. Okay. Yeah, Alan wants to know, when you look at the net debt to free cash flow, do you look at the 5 and 10 year chart? Yeah, I think I'm more interested in like the most recent number. I like to see the trajectory too, and like where it's trended historically, but I like to see the most recent number just to see where things are at right now, for that. Okay, but anyway, Patrick, I kind of teased your question here, so let me take another sip of Fresca. And guys, this is probably going to be the last question of the night here. We're 12 minutes past the hour, and I gotta make myself some dinner. We got some leftover pasta. Real quick though, one for all. I'm not going to go too in depth on these, but I think these are both really solid growers. Really interesting companies. I'm a little bit, really interesting companies. ASML for sure right now has a monopoly in what they do. That's great. Maybe that will change over time. I don't really know enough about lithography to know how that will change. So that would be worth considering. With Intuit, I think that you could make the case that TurboTax is becoming less sticky over time. I think that otherwise, though, products like QuickBooks will still be pretty sticky, and I think the switching costs for that can be kind of high. But at the same time, actually, maybe someone like Dan, who is an accountant, maybe Dan, you might actually have better insight on this than I do on Intuit, and I'd actually be curious to hear your thoughts. But I use QuickBooks myself. I've used TurboTax in the past, and I will say, if you use TurboTax 1 year, they make it super easy for you to continue the next year. So I think they do a really good job of that. QuickBooks, yeah, I've used for years and don't really have an intent to switch. But yeah, a monopoly doesn't guarantee demand. That's true. That is true. But a monopoly is a competitive advantage, and that's what I was trying to get at in saying that. So, but anyway, back to Patrick's question. Do you have a number that you try to hit for dividend profiles? I try to get current yield plus dividend growth to 10%. Example, 4% yield plus 6% growth would get in. Thoughts on that thinking? Yeah. And I think Zal made a comment about this earlier in the stream, but that's something that's called the Chowder rule. And I know the Dividend Talk guys are actually really, really big on the chowder rule, where you add the 4% yield and the 6%. Well, you'll add the yield and the growth rate together. And let me know about this in the chat, guys. Your take on this. Some of you guys who maybe are a bit more better versed in the chowder rule than I am, but my take on that, and the reason that you might use the chowder rule is the yield part's obvious, right? Because the yield is half of the equation when it comes to total returns. But I think maybe you use the chowder rule or the dividend growth rate as kind of an estimation for what future share price returns could be. So maybe that tells you like your expected return moving forward. Because when you think about dividend yields, they tend to trade in a certain range. Like Lowe's, for example. Lowe's historically has not been upwards of like 4%, 5%, less than 1%. Lowe's tends to trade somewhere between like probably like a 1.5 to 2.5% dividend yield. Maybe the range is slimmer than that, but the gist of it is stocks tend to trade within certain yield ranges. And and that's why you can kind of use a dividend growth rate as a proxy for expected share price growth rate as well. Because if a stock share price was growing at a slower rate than the dividend growth rate over a long period of time on average, then over time, the stock's dividend yield would continue to increase to the point where it becomes out of its normal range. And that just, you don't really see that too often. Typically you see, because stocks tend to trade in a certain yield range, the dividend growth rate can give you a sense of maybe what expected share price returns have been or could be because of that range. Let me know what you guys think about that line of thinking. But I think that's kind of my take on it. Yeah, absolutely. You guys are saying don't chase yield and all that stuff. Absolutely, don't chase yield. And Russ, you're right too. The big issue is that it fails to account for dividend cuts or eliminations. And generally speaking, you can't just look at one thing when it comes to investing in a business, whether it's the yield, whether it's the free cash flow growth rate. You can't just use one singular metric. Although, and Russell attests to this too. Although there's some books out there like they have tried to establish that, like, if you had to start with one overarching metric that can help you gauge the quality of a business, like there's got to be one that you can use as a proxy for like general quality and worthiness. And if there is anything like that, it would be the returns on invested capital, because it can tell you a lot. It can tell you a lot. If a company has a high return on invested capital, then over time you should have seen solid returns from that business. And I think actually Domino's is a pretty good example of that, right? This chart's kind of freaking out. So anyway, but generally speaking, if a company's had historically high returns on invested capital, the share price returns also should, and the total returns, I should say, should also have been pretty respectable. But with that, the returns on invested capital tell you something about how the management team is deploying capital back into the business. If they're using their capital effectively, if they're good stewards of the money that they have to invest and reinvest, then that will be reflected in the returns on invested capital. So that tells you something about the management team as well. So let me just add that asterisk to what I just said. You can't just use one particular metric. You really can't. You have to look at things holistically when you're analyzing investments. But if there was one overarching metric, it does seem that the ROIC is probably like the closest thing that you can get. So this is an interesting comment. Falcon Strike says, dividend stocks are so popular that they become crowded trades. If an economic crisis happens, the crowded trades will be the most volatile. I agree with that general sentiment, but I don't think it's fair to apply that to dividend stocks as an entire category. I don't think you can do that. I think you can certainly apply it to individual companies, but no, I don't think you can apply that to a whole group of stocks, whether it's dividend stocks or quote unquote growth stocks or quote unquote value stocks. I just don't think you can make that generalization. But like I said, you can do it on an individual company basis. It certainly can happen with dividend stocks. It can happen with non-dividend stocks too. I think we can all agree that you're seeing that play out right now with certain stocks like Palantir. You've seen it with Nvidia. There's always going to be a hot stock of the moment. There's always going to be an it stock. And to your point, Falcon Strike, that's how it works. Things catch momentum, and that brings other investors into that position because they see other people making money on it. So they want that for themselves. So they start piling in, which pushes the share price up even more, which pushes even more people in. And it becomes this vicious cycle that while it exists, it can't go on forever either. There is a point where that type of behavior cannot be sustained. The party has to end at some point in time. When a stock's valuation becomes so far detached from its actual fundamentals and from its intrinsic value, that momentum can last for longer than you might think it can, but the chickens always come home to roost. When that happens, it's anyone's guess, but to your point, that is how it works. And that's not to say that certain stocks like Nvidia or Palantir are bad companies at all. That's not to say that at all. All that's to say is, like, there's some stocks that people buy without any regard for valuation, just because they're the it stocks at the moment. So. So, guys, with that, though, I think this is a pretty good place to wrap it up. We put in some good time tonight, an hour and 20 minutes. This was a fun stream. Best one yet, maybe. I don't know. It felt good to me. It felt really good. This is a good one. Good questions, good turnout, good group of good group of, I was going to say good group of guys, but yeah, great group of investors here tonight. And with that, I want to thank you guys so much for hanging out with me this last hour and change. Before I let you go, a couple things for you guys. First and foremost, on Sunday, my next video I'm putting out is going to be the monthly portfolio updates. No, I just put that one out. Sunday's video, guys, is going to be a full revealing of my portfolio. I'm going to go through literally every single individual holding one by one. I'm just going to show you the state of the portfolio as a whole and where things are at. It's going to be a whopper of a video too. I think it's almost 20 minutes long. So buckle up. But if you guys have ever wanted to see my entire portfolio, that's going to be the video to watch. That's going to be coming out Sunday. The one after that's going to be the monthly Q&A video. So, and that's a good one too. We've got some good questions in there that I think you guys will like. So check that out. That'll be coming out Wednesday. And I've got both of those done and uploaded already, ready to go. Since I'm going out of town in a couple days, I needed to kind of just get them done heading into the weekend. So yeah, a couple good videos coming up. I'm excited for you guys to check them out. Fun ones to make as well. But anyway, guys, that's all I got for you. Otherwise, thank you again so much for your time and for hanging out with me. You guys are the best. And I hope you guys all have a great weekend and a good week next week too, if I don't see it or hear from you. But yeah, keep up the good work, my friends, and I will see you in the next one. Take care.